Thursday, July 31st. This is Stocktwits Daily Rip Live. I'm Katy Perry here with Shay as always, and we are joined by the big dog, Howard Lindzon, and Eric Saltz, CEO of Alto, a platform that's rethinking how investors access alternatives through their retirement accounts. Welcome, everybody. It's good to have a full house today. Eric, this is your first time on the show, correct?
It is.
How you
Great to be
feeling?
here, Katie. Thank
Yeah.
you.
Where are you dialing in from?
Gloucester, Massachusetts, of all places, about
Ooh.
40 miles north of Boston. And people who have seen The Perfect Storm or the movie Coda will be familiar with where I am. Very blue-collar fishing village community.
Nice, nice. I would not guess that's how it's said based on the spelling. So thank you for
It's very
phonetically.
English. It's an English spelling.
Yeah. Well, Eric, I know we got a lot to talk about by way of just like future of investment in alts and previously inaccessible asset types. We're gonna start with the news, so we'll tag you in on some news items. But before we get to the kind of the second half of the show, we're gonna go deep with you. Real quick, what's Alto? How did it start? And let's get some context on you, and then we're gonna flip over to everything that's going down in the markets because a lot went down yesterday.
Sure. So Alto sits at this nexus of alternative assets, retail investing, and retirement money. And so we enable individuals to access their individual retirement account and use that money to invest in alternative assets, private equity, venture capital, real estate, crypto, fine wine, other types of collectibles, artwork. And we just make it easy and affordable for people to do this. And that's what Alto is.
All right. Well, it looks like 60/40 is getting flipped on its head. We will go back over to that. Seems like in large part due to the Robinhood generation, as Howard you like to call it, the Degen economy. So let's start there. Hood earnings. Uh, they ripped. I thought it was interesting. They did their earnings live from Nasdaq market site. Vlad seemed to forget his hair product this time. I don't know if we saw the visuals of that. He was looking a little fluffy, but he doesn't matter. They crushed. Shy, let's start with you because we've been leading up to these hood earnings, and I know you have kind of a vision of how they're trying to position themselves. Is this what you expected from them? I think they had 45% revenue growth, and some other big numbers.
Yeah, I mean their net deposits I think in July, which they didn't report, was like above 6 billion. So you're showing signs that third quarter is off to a strong start. You're seeing that crypto is becoming a dark horse again for them as a margin expansion opportunity, top line growth. I think that Robinhood's continuing to innovate on the product front, and you're seeing it reflected in the fundamentals, and it's driving more wallet share, more like top line growth, EPS beat. Like look at that, 42 cents beat 31 cents. That's not a casual beat. That's 25 to 30% higher. So I think that this was a strong enough report to justify his price to stay at this level. Look, being down 0.3%, I think that's a W for the stock tripling in 3 months. Now it's a $100 billion, close to 100 bill market cap. You have to ask yourself, all right, what's next being priced in that isn't being reflected in the stock right now? And I think right now they just have to continue their crypto momentum. I think you saw everything you wanted to see as a shareholder in that earnings report yesterday to like feel comfortable holding it at this level. And I think that things are hitting on all cylinders. I love that Vlad is disrupting the not just the product front, but also the earnings front of being able to like have an interactive experience on the earnings call. Like, I think it's a sign of more to come from a lot of different competitors, where the democratization of investing is an absolute real thing, and now he's bringing it on the analyst relations front as well, having people go there in person to ask him the questions live, having some FinTwit people there, having some real analysts there, like merging them all together and just creating like an interactive experience. Like that's really cool, and that's something that I think is going to be a continued thing, because you want to see these CEOs answer the questions, how they react to the questions. Carp is doing the same thing. They're in that office boardroom. And look at the stocks. Carp, Palantir, and Robinhood, they're killing it. And I think it's because these optics are working for them. But it's not just the optics. Fundamentals are just wow for Robinhood,
Yeah.
and congrats everyone.
Yeah, Howard, I want to get to you because a couple things. One, I know you were early in Robinhood, so I'm curious if you're feeling like a proud papa, but also Degen economy with the live audience in the earnings call. It kind of was like good thing it went well. Like if I kind of want to see a live earnings call audience with a bad readout, but what's your take on Robinhood, both their results and how they're sort of navigating their retail investor relations?
Two things stand out. Obviously, when we invested, they didn't have their license yet. So I'm thinking about the first time I sold Robinhood in the private markets, and not through Alto. Just full disclosure, I'm also an early investor in Alto IRA. Not big enough. I think I passed for the most part, but I've got a little piece of investment in Alto because it's such a great idea. But with Robinhood back in the day, 2014, there was no such thing as, I would say it was like Airbnb and Uber were like unicorn, right? So unicorn wasn't like something that was an early, unicorn. So unicorn wasn't something that was thrown out around a lot. And I think within 2 years of us investing in Robinhood, it became a unicorn. And of course, I'm like, what are the odds of me investing in a unicorn? So I remember selling some Robinhood that we had acquired at because it wasn't in our IRA, selling some at $1 billion. So that was 100 bagger left on the table.
Oh no.
Yeah, but it was 100 bagger very quickly to get to $1 billion, because back then prices weren't like they were like today. So the seed investment was under a 10 million valuation. So looking back today, I'd have to say from the 1 to 100 billion, if I'm going to look about the number one thing that worked, and I'm actually proud of, yesterday they shared a chart that assets under management are 900. I don't know, they were like 279 billion, maybe it was 929 billion. Sorry, that's a big differential. Sorry, I don't have the chart in front of me, but they shared it. And so to go from 0 to, let's say, 300-400 billion under management really is the epitome of what this idea was. You've got the GameStop, you've got the Vlad and the Baijiu and the the near-term death experiences in 21, 22, and what I call the degenerate economy, and then their options trading was 279 billion. So I remember being probably the first, one of the first people to have money on the platform, and so to see 279 billion is like, okay, that's pretty impressive. Next stop, Schwab, but like Shay says, Shay, is it Shay? It's been
Shy.
so long. Yeah,
I'm gonna jump in there. You don't have to do it. It's Shy.
Yeah. So like Shay says, the earnings conference call, like MBA style, they're bringing back a lot of the things that people wanted to see at the beginning. So they're getting some swagger back. Some would say too much swagger. Forbes had a great cover shot of Vlad, and old people like Eric and I cringe at stuff like that because, Forbes should have been writing this article when the stock was like at $20 and no one wanted it. But now they're writing that when the stock's at $100. I think Vlad did a good job cutting his hair to kind of like hedge the whole cover story in Forbes. And what's that?
Pun intended.
Yeah, you mean his actual haircut? Because he did get a haircut.
That's what I'm saying. So the Forbes cover has him with the long hair and Crypto Evolution too, and he goes, "I'll hedge that when that comes out by showing up with short hair." Like he's playing both sides. He's not buying into the old momentum and cover. So the numbers speak for themselves. People are going to argue now on Robinhood and all these great companies like the Ubers, the Airbnbs about valuation. That's the tough one, right? The price is the price, and the market cap is the market cap right now. And there's this whole disbelief going on between, price and market cap.
Things a little bit differently this time. We're going to be streaming live.
Yeah, and so, we're in this, and we've got 8% interest rates. So I think what Shay said is important, right? The fact that the company blew away numbers is great. The fact that the stock's barely down after having such a run is really kind of a great thing. It's really not giving back its gains. So I think it'll take a market event right now for some of these leaders to pull back. So
Yeah.
kudos. They're crushing it.
Eric, I wanna
Eric,
get-
you know this well. So
Yeah, I want to get Eric's take because I'm curious. They've been getting more into alternative investments, the tokenization stuff. How do you think about that in terms of what you're building? Slightly different business, but does Robinhood, the most mainstream, I would say, brokerage among young people, pushing those things forward, does that sort of lift your what you're doing in the market?
Well, I think a rising tide lifts all boats. So it's a great question. I think what we're seeing is a convergence of public and private markets happening, and it's happening from many directions. It's happening with tokenization of real world assets and securities. And one of the things that I think Vlad and Robinhood have done such a good job of is attracting new capital from a demographic that they weren't really addressing in the early days. And so I think they're going up market effectively. And as that happens, we can really begin to talk about true democratization of access to private market assets. It shouldn't just be the ultra high net worth investor. It should be the mass market. It should be the mass affluent. And I think what's really nice about what's taking place in Washington today is that policy is catching up with where I think the world has been for a long time. And I think Vlad and Robinhood know that.
Yeah, I want to get into that later. The accredited investor conversation is so interesting. But let's move to some other earnings. I do want to add one more thing about Robinhood, which was interesting. Their prediction markets, that's a $2 billion traded. So FanDuel handles about 23 billion in bets across all states, and that was last year. So that's how big of a business it is for Robinhood, but how big it could be. Let's shift over though to Microsoft, and there's a lot of earnings. So let's do some like lightning round takes. Shay, we briefly touched on Microsoft. I think the story there is the cloud. What are the highlights for investors looking at Microsoft's blowout earnings from yesterday?
Yeah, I mean, lightning round. If you're questioning the AI boom, stop questioning it. It's here. This is an inflecting quarter, and you saw it in Microsoft's cloud earnings, where the amount of they brought in $4.3 billion this quarter alone. That was more than 2x their previous record in company history. That combined with what Google Cloud reported as well last week, what Meta's reporting, I think we're finally seeing that ROI being reflected from AI investments. And I think that it's going to change the tone now on these CapEx numbers, the willingness of shareholders to digest these CapEx bumps. Because Microsoft, for example, estimates for $18 billion. They're going to be spending $30 billion now on AI CapEx. That's not just a casual bump. That's a substantial above estimates. And guess who's going to be printing that? NVIDIA. Like NVIDIA is going to continue just cashing in from all these like hyperscalers, like continue their AI spend increase. And it's also justified now because you just saw these Azure numbers. I'm still mind blown that Azure was able to grow 39% year over year at that kind of runway, $75 billion runway. That's mind boggling to me. And the fact that they just 2x their previous record amount of money being into their cloud in that one quarter is showing that things are accelerating really quickly, and that they're finally seeing monetization happening after the experimental phase of AI. Now it's on to the deployment phase, and that's when we're really going to start reeling in the cash. So I'm stoked as an AI investor. It's finally happening, and I think you're going to see a lot of cloud software names get bids from this week's earnings reports.
Yeah, and Satya Nadella, not one of the flashier Mag 7 or even one of these nouveau CEOs we follow. Sort of a silent assassin, but
Satya was a little spicy yesterday.
What?
He was throwing a little shade to AWS. Like
I love it. Good.
Yeah, he was like claiming that we're growing close to 2x what AWS was going to report on the growth rates.
All right.
Our revenue is almost in line, 75 bill. I think AWS is like low hundreds, 110, 120. But yeah, he was throwing some shade.
The Degen economy, right? Everyone's got to be spicy. Let's go to IPOs. Howard, I'll pop it over to you. Any thoughts on Figma today? This is a big, it's one of those IPOs that the circle jerk of Silicon Valley will love. Figma, obviously popular design tool. They had a failed acquisition attempt by Adobe. Really disrupted Photoshop for collaborative design. They're doing a lot by way of AI. They are going out today. A lot of excitement around this one, and it looks like the Stocktwits crew are users of Figma. Thoughts on Figma or IPO space right now in general, Howard? Howard, you're muted.
Sorry, everybody. Amateur
I feel like
hour.
you
So,
probably just said something so amazing, and you're never going to be able to replicate it ever again.
no, I just yelled at all the staff around me to get me a coffee and an Adderall. So that's all you missed. The Figma IPO is great. Listen, we're getting what we asked for. Are we getting it at the right time? Is always going to be the question, right? The question, and this goes to Alto when we start digging into private markets, is what's taking so long for these companies to get public, right? So the real story here is not that it's public. Go look through who the early investors were, right? Like Index, which was also an early investor in Robinhood after us. So a lot of this money, and let's see how it does post pop, is in the private markets, right? So if I look at a company like this, just always reminds me of a company like Square or Block or XYZ, whatever his ticker is today, old Jack. And back then when Square went public, it still at least had that run from 10 to 70. The stock's done nothing since, because there was back in 8-9 years ago, even 8-9 years ago, stocks were overvalued when they came public. So this whole trend of like going private late is just an exhausting thing. It's been why I switched to seed investing from public market investing, and we've come back full circle now that Figma are going public so late in terms of valuation that it's, why would I care about new companies going public when it's really the Mag 7? So the reason we have this Mag 7 diversity is because private companies are going public so late. The real Microsoft story is OpenAI, right? Like, why are you buying OpenAI when Microsoft owns OpenAI in so many ways, right? Like the revenue and the profits are going to flow to Microsoft based on Satya's deal. So I can see why he's throwing a lot of shade around, because if you actually do the homework, I'm like, you can own Microsoft if you want to own the whole goddamn thing right now. So with Figma, I think it was probably great for them that they didn't get, today they're celebrating that it's great for them that the Adobe deal didn't happen. But for a year or two, there was a lot of shareholders and a lot of young people that worked at Figma that were in, the world had kind of been shut down to them. And Eric, again, knows how this all goes, right? So we've just messed up this liquidity. And I could go on and on about this as it applies to so many things since Web 2 started. But this movement of money to private markets is really caused unintended circumstances. So it's nice to see Figma get public. We'll see where the gains were most and how well it does over the first 2 years. So that's what you want to track. Is where are the gains? Who made these gains? And Eric, you may have a thought there.
Look, we used to have 9,000 public companies. We've got less than 40,000 today. And it's because what's happening in both venture capital and private equity is that the supply of cash to those asset managers, to those general partners has become so large that they can make decisions much faster than the public markets can, and without all of the reporting headaches. So it all kind of makes sense. But as an investor, if you're not getting access to these private opportunities, you're not going to get the alpha return. You're not going to get the outsized return. You're not going to get portfolio diversification. I was kind of laughing when you said the Mag 7 diversification. I mean, that's not really diversification. If you're not invested in the Mag 7, you're losing in the public markets.
Yeah.
So that's a tough one.
Yeah, the other thing is now we can see it. Listen, Figma's got a big market cap, so while they can, can they grow organically? We'll see. I mean, they're going to grow organically, but the question is, who do the returns from all this slower organic growth come from? But now they have a market cap that allows them, and a currency that allows them to go do acquisitions. So the one thing that why we need functioning IPO markets is what comes next, right? Corp dev, buying up businesses that can't get over the hump, acquihires. They have a currency to go do things. And again, this was one of the beautiful things about public markets. This is what's made Satya and Zuckerberg so great as businessmen. They use their stock as a currency to go do things. Facebook, you want to gloat all day. It's a one-trick pony. But who isn't a one-trick pony is Mark Zuckerberg. Like, he's a one-trick pony on product, but he's been able to use his power and stock price and cash to go do acquisitions that nobody else could do. So another reason why the FANG continue to perform well, it's like a company that's going to get bought by one could get bought by four. And so the more IPO, the more public companies that have great businesses, the better, because the more the flow of money happens and the more liquidity is brought into the market for buying companies that may or may not get to the next level.
Let's table the public-private thing for a bit, because I know, Eric, there's a lot there to unpack with what you're offering. You did mention Meta, Howard. I want to talk about those guys. They had great earnings. They're interesting in that, their growth people-wise is pretty stable over time. I mean, everyone's using their products. Their advertising revenue, I think, was up 11%. So it's the same, basically a flat number of people spending more time, and they're attributing that to their use of AI, not only in these like flashy super intelligence team efforts and Llama, but like in their advertising products to get people to watch more ads, buy more stuff. Shay, Meta, thoughts on Meta? And when you talk about the Mag 7, we were talking a few days ago about just the divergence of performance across some of these guys. Meta's been performing well. Did you have any takeaways or anything that surprised you out of their earnings report from yesterday afternoon?
I mean, the fact that Meta reported 38% profit growth while still dropping 70 billion in capex is absolutely nuts to me. Like, he's going full sprint on investing with AI, but you're seeing them, their bottom line and margins exceed expectations at the same time. And I think that Meta is clearly graduating from what the narrative used to be about that company, where it was all about monetizing eyeballs. I think they're monetizing intelligence now. And when you have combined that with the fact that nearly half of the world is logging into a Meta app every single day, that's a massive lever for them to pull to layer AI across all that infrastructure in a way that is going to just be a cash cow machine for them. That's going to turn into margins that are going to be unfathomable. Like, it's going to be kind of crazy where there's a reason why he's investing billions of dollars into data centers and LLMs, because it's not that he's trying to compete on a headline with all the other players in super intelligence race. It's because monetization is already happening for them, and it's happening at scale. Imagine if they have all the tools necessary in order to max out their AI capacity, what's going to be possible on the monetization front. And if they're producing 22% year over year growth, 40% profit growth right now, and they don't even have all the tools necessary, wow, just wow. So I think that when them spending 100 million bonuses per person, some are 200 million, fine. That's not a big deal. This is a $2 trillion company. And when you think about what's at risk if you fall behind it in the AI super intelligence race, I think it's at least a 25% haircut if you fall behind. Look at Apple. Apple had a 25% haircut on their valuation this year because everyone's side-eyeing what they're doing on the AI front. So for Meta, 25% now is $500 billion. I think that is why he's so willing to spend so much money on capex and talent, because he knows that $500 billion is in line right at risk right now if he does not deliver an AI in the next couple of years. And they are. We're seeing proof in the pudding.
Well, we'll find out more from Apple after the closing bell. Howard, do you have any thoughts on Meta? How does Meta fit within the Degen economy?
Well, I mean, my take on all these guys is um, they've 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 worked together. It's cynical. They've worked together, and they have a useful idiot in the White House. Trump is doing his Trumpian things, and Meta and crew showed up at the White House, and they're getting everything they wanted from their czar, and the whole crew is kind of joined in with Goldman Sachs and J.P. Morgan. There's a whole new crew in the White House. It's Goldman Sachs, J.P. Morgan, combined with the technology Andreessen and the technology bros. So they're getting the valuation. They're getting the laws that they need, and they're getting the tax breaks that they need. So it's kind of a perfect storm for this wealth gap, which if you got a wealth gap that's growing, you also got this Mag 7 gap that's growing. And so I don't think anybody can truly explain what is it, a 10% move in a
Yeah.
$1.5 trillion stock. I think they said that the moves yesterday in Meta and Microsoft are larger than the whole market cap of Europe.
Yeah, it's
So
crazy.
it's not so much that it's crazy or anything. Europe is not a tech. You know, you got LVMH, which is kind of like a symbol of what a hot stock was in France, and Hermes, and then they're all getting crushed with these tariff plans of Trump, right? And in the United States, that's Lulu and Deckers, and then you've got tech companies investing, not so much really getting the results. Yes, just investing capex and going up 10%. So I mean, this is a
Yeah, some of the
very interesting time. A lot of it is political. A lot of it is just the market expressing themselves in a way that says these guys have bought their future. They have a useful idiot in the White House who doesn't understand tech, and and I think investors are saying, I can't fully explain it, but I'm going to own tech. And at the same time, Lulu, Nike, Deckers, LVMH, now copper yesterday, huge move down after a huge move up. The economy is being gutted, and tech is not letting themselves be gutted right now, and it's showing up in these gap ups. So
you mentioned, you mentioned the European stock market too. I want to, because that has been a trend with some of these bigger, more innovative tech companies in Europe and the UK listing here. One of those being ARM Semiconductor, which was one of the more popular IPOs. And I know, Shay, we talked about them yesterday. They also had a strong earnings beat yesterday as well. So I think that's something else to watch. These big tech companies, they're opting obviously to come list here versus elsewhere. Shay, before the opening bell, any quick takes on ARM? Because I know that's an interesting one in terms of what they're doing by way of data center buildouts.
Yeah, we actually spoke with Renee, the CEO, and I think ARM is just being misunderstood by the market. I don't think people realize it's not really an earnings story as much because they power half of the data center market. So when you have Microsoft, Google, Amazon, NVIDIA all designing their future around ARM CPUs, I think that's a pretty massive mode. And right now they are just going through a product transition on going from a licensing model, which essentially they were just licensing all these products, to now becoming a potential Broadcom competitor in the data center space. And that costs a lot of investment. And that's why the earnings look a little off. And it's also an expensive stock. So I think this is purely a valuation pullback, not an execution miss. And it's really important to know the difference between those two.
Yeah. Well, I spoke to their CFO last year and learned they have a lot of ex-Amazon people running that company. So it's they have that sort of DNA in them too. Of course, that was the opening bell. We are getting ready for another day in the markets here. Eric, thank you for entertaining us. We like to, yak a bit and bounce around as the show starts, but you are a special guest today. And the topic we're talking about is so top of mind, not only for investors, but also on the Hill. lots of conversations around some of these legacy rules around who can invest in what and how. Let's kick off there, like the state of the accredited investor in the US. Can you quickly just give us a high level what was the policy before, what is being pushed to change, and why is that changing in this era where people have so many tools and resources at their fingertips to learn about these opportunities?
Yeah, it's a great question, Katie. And I would say that the original AI is actually accredited investor, not artificial intelligence. But up until this moment, to be an accredited investor, there was either an income test or a net worth test, right? And what's changing, what's on the verge of changing, it's already passed the House. I think it still needs to go to the Senate, is how we define accredited investor. And basically what this law will instruct the SEC to create a test such that if any investor can pass the test, they will then consider to be a suitable private markets investor, and they will have access just as someone who has a certain amount of net worth or income, and they'll be able to invest the same. And I think it's this switch from a philosophy of wealth begets wealth to knowledge begets wealth. And I think we should all have that same opportunity to do better than we currently may be doing. And this is really at the heart of democratization, because these markets have been closed off to all but the ultra high. Unless you're Howard, you don't get to invest. And I think Shay and I should be able to invest too, right? So we should be able to take the test and bet on Robinhood in the seed round.
Well, it is funny that I'm curious what you guys think, like who's like against this, or is it just not a priority? Because it's crazy to me that you can easily trade options on margin, but you can't get a piece of a and roll or something without having a certain amount of wealth. So like who doesn't want this to happen? Is it just the the ruling class, so to say? Like why hasn't this changed?
Like, I think we need more than 30 minutes to really dig into that. So I'm going to give you my lightning round answer.
Okay.
And it has to do with two things. One, there's this misconception that if a company is public, that it's an okay investment for investors. All that really means is that it has checked all the necessary disclosure boxes with the SEC to go public. It doesn't mean it's actually a good investment.
Mm-hmm.
And what we know is that 95% of all companies that go public ultimately fail. Okay, that's just a statistic. And as we were talking about earlier, if you're not invested in the Mag 7, like if you took the Mag 7 out of all the other indices that are publicly traded, you do not have a good return, right? And so that's the first thing. There's this misconception of what it means that a company has been able to go public, and therefore it's a good investment opportunity. The other piece of this is just historically a paternalistic attitude that we need to protect Americans from themselves. That they're smart, they're not smart enough. They don't know how to make these investments. And what I would say is that we are literally at the Charles Schwab moment of private markets. So Howard's going to remember this. Shay and Katie, I think you're too young, but there used to be an E.F. Hutton commercial that would often play on Sundays. And the commercial was, when E.F. Hutton talks, people listen. And if you looked at the scenery of where these commercials were shot, they were on yachts or they were on golf courses, and it was just a bunch of old white guys. And basically what it was saying was, you have to be wealthy enough to have a financial advisor. And if you have a financial advisor, then you can participate in the public markets. And what was so brilliant about what Schwab did was he came along and said, no, everybody can do this. We just need to provide them with the tools and the educational material. And by the way, we're gonna put a store on every corner across the country of Maine and Maine, and we're gonna let people walk in, and we're going to teach them how to invest. And here we are today. And Howard, I don't know if you remember that, but that's a big difference.
It's funny you articulated Schwab as like the disruptor, like rough around the edge. Because now when people talk about Schwab, it's in the context of like Robinhood and Webull. It's like Schwab. Schwab's like the F hun.
No, but here it is. We used to go to the malls when we were kids before the internet, right? So, and that was the old Peter Lynch thing. You know, if you get familiar with the products you buy off the shelves. So again, I don't think people cared. This used to be a very retail-driven stock market, not retail investors, but like the Gap, Abercrombie, Sears. You know, that was how those were growth stocks, right? Because America was a big country, and you used logistics and everything to build a great public company. Was considered a retail stock, right? Because there was just this unit economic growth and how many stores can you open next year. But along comes the internet, right? So now the consumer is on the internet. So of course that led to Schwab, Daytech, all these things, right? And because then Web 2.0 and YouTube, the private, luckily accredited investors of that era on the internet could get pieces of those companies. So here we are now, I don't know, 20 years after the internet, 25 years after the internet, AI comes along. I think it's a great thing, but this is going to be hotly contested in the media and clickbait about who's going to win and who's going to lose, right? And you've got Sequoia and all these guys are going to start launching these forget what target date funds that mix private and public markets. And it is very hard for the average individual to size up a private company. But again, we can't treat these people like idiots. We have to start assuming that Americans can make decisions for themselves. And you can go buy bullets at Walmart and a gun at a store, and we're worried about them, investing in Robinhood because they have knowledge about the industry. So again, these things are all just way behind, but people are going to do stupid things with this freedom. But I also am confident that the only way to move stuff forward is to let these people learn. And so it's up to companies like Alto, it's up to companies even like Stocktwits to just educate. It's up to Shay. This is why Shay is so popular and you're so popular. It's up to us to educate these people. They're not going away. We can hate on Trump. We can hate on the current administration. We can hate on the current policies. But in the end, we don't need more regulation. We need less regulation. We need enforcement of said regulation when grifters and other things come about, and when companies that have the right when the companies have the right to sell stock to shareholders without that much disclosure of being public, abuse it. And so we're going to have to hold those companies accountable to the laws we already have. But man, this is a good thing. And by saying that, people are going to be mad at me saying, oh, we're going to let dumb people and, poor people invest in private companies.
Here's the thing that is funny to me. I live in New York, Shay's in LA. It's a logical fallacy to assume that because you have money, you're not dumb. In fact, I'm around dumb rich people all the time. Like I was just in line behind a couple of them at Pratt. Like, so yes, there's less to lose.
I was in that line, so
I know. Sorry, Howard. I didn't mean that wasn't like I'm not trying to like passively aggressively shade you. I just mean like just because you got some money in the bank does not mean you're an intelligent person who understands investing. And I think Shay, I want to get your thoughts because you're like deep in the community and you're like part of this new wave. And it's like you have people who are very sophisticated digging into this stuff coming out of nowhere. And like even looking at your growth as a creator. So like what do you make of this? Because I mean, you focus mostly, your guys are focused on your themes at Futurum, but like in terms of accessing other types of asset classes, your generation, how do you guys think about that?
I think, this is a great conversation. I think a lot of the reason for the pushback from a lot of the, I don't know, let's call them institutions, is the fear of getting displaced. I think a lot of the new currency is eyeballs. It's going to continue being that going forward, especially when you have AI causing a productivity boom like we've never seen before. That's going to cause a lot of competing products. And what's the differentiation between all these competing products. It's an eyeball, it's an IP, it's a personality, a brand, etc. So when I don't know, FanDuel blew up 5 years ago, there was like some great takes on like the past couple years on some great analysis from retail Joe Schmoes in their basement of the parents' house or whatnot on why this stock belongs to get re-rated higher. And the beauty of a lot of that analysis was it was forward looking. It was a lot of putting your finger in the air, seeing where the wind's blowing, what the world future is going to look like. Analysts in the traditional finance route, like they're very backwards looking. They're very much like, if I don't see proof in the pudding, I'm not going to factor into my decision analysis, etc. Those days are over. Now it's all about what kind of narrative, what it's turning into, and you're seeing like the Robinhoods, the Palantirs, the Rock Labs, AST Space Mobiles. Like it's showing that if you have great IP, great technology, a great story, that fanship will follow and execution will follow as well. So I think that eventually, like data and access still matters a lot, but I think you have to pair that up now with the new form of investing, which is eyeballs, narrative. It's a new derivative, and that's why future, like Daniel and I partnered up, because that is kind of the future we're heading, where that institutional wall, the reason there's a wall up there is because that's their moats. That's the only way they stay competitive. If you start taking down that wall and democratization happens, now it's a free for reign on access. They're scared because guess what? The reason they're right isn't because they're the smartest people in the room. It's not because they're, like, again, like you guys said, being rich doesn't mean you're smart. It's because they're closest to the decision makers. They have access to what's actually where the puck's heading. They had a disadvantage. They had a retail that had a disadvantage compared to what they had, and now that wall is getting taken down, more even keeled. They're a little worried because now they have to work a lot harder just to get to the same level where they were before, and now they're upset about that. That's how disruption happens.
Mm-hmm.
Katie, if I could connect a couple dots, you sort of joke about Schwab being a disruptor, but there was a time where an average cost per trade could run you a couple $100.
Yep.
Schwab came along and said, you know what, it's going to be $49.95.
Yep.
Robinhood came along and said it's going to be $0.
Yep.
But for a while, $49.95 was pretty damn attractive.
Yep.
And that's and there's also this old joke about the fastest, with private markets, the fastest way to become a millionaire is to start as a billionaire. To your point.
Yeah.
It really shouldn't be about how much money you have as to whether or not you can make a certain investment.
Yeah.
And by the way, 50% of the country is employed by small businesses. We're taking a much bigger risk on our day-to-day livelihood than we are if we invest the money in a private company.
Yeah. We talk conceptually. I want to talk tactically for a bit, Eric, and like how this all comes into play on Alto. So give us a breakdown. This is it's a platform where retail investors can do what with what, so that what?
Great questions. All about what?
Yeah. And why, but what mostly?
Absolutely. So historically, investing in by the way, I think this is also interesting. We up until now, we talked about this as alternative assets. The alternative asset industry. Now, if you read articles in the Financial Times, the Wall Street Journal, the New York Times, wealthmanagement.com, I don't think anybody actually reads wealthmanagement.com, but if you do, great. It's not alternative assets anymore. It's private markets. Why? Because alternative assets sound scary and private markets sound great.
Mm-hmm.
It's what the ultra high net worth and the institutional investor is looking for. And so at Alto, and by the way, you can go to altoira.com, so you don't have to listen to me talk about this stuff. But we have created a platform that makes it easy and affordable for individuals to invest in private markets using their individual retirement account. And if I could just for a second, so today we have about 30,000 customers, a little more, I think. And well, there it is, 1.8 billion in assets under custody. And what most people don't know is that you can have as many individual retirement accounts as you'd like. And so let's say right now you have an IRA with Fidelity or Schwab. You can, and you're investing in the public markets there. You can also open an Alto IRA and you just transfer cash from Fidelity or Schwab to Alto. And then we give you the ability to invest that cash in private equity funds, venture capital funds, direct companies, real estate, crypto, etc. And so that's the kind of what. The other important piece here is when you make investments out of a retirement account, you have to have a custodian. So we have Alto Trust. So we have a wholly owned trust company. So we also serve as your custodian. And then we have a wholly owned securities business, Alto Securities. So let's say you're not Howard and you don't have a network of investment opportunities, but you're looking for some because you want to diversify. You can go to the Alto marketplace and you can find farmland funds, private credit funds, Hamilton Lane's private asset funds, Franklin Templeton's blockchain funds. And I think that this is a really important point, right? So let's take Hamilton Lane, for example. If you're going to invest directly in the Hamilton Lane fund, you have to be able to write $1 million check. Most people can't do that. At Alto, it's a $50,000 check. And so we will aggregate or pool those investors together and then send the check to Hamilton Lane at the end of each month. And then we'll handle all of the administrative back-end side, the distributions and the reporting, et cetera, all of that. And by the way, $50,000 is still too high.
I was going to say, what goes into getting that buy-in price down? Is that a tech issue or just
so right now that's a GP issue.
Okay.
That's Hamilton Lane says, you know what, we're going to cut this off at $50,000, and a $50,000 investor can participate in the Alto feeder fund that goes into Hamilton Lane. But what we're seeing happen right now is a lot of the largest asset managers in the world, the Blackstones, the Apollos, the KKRs, they're all creating interval and evergreen registered fund opportunities for smaller investors. Now, there are different issues from my perspective with respect to that, because these are publicly traded vehicles. And I do not believe you should be using your retirement capital in something that is so liquid, because what most people don't talk to is that you're accepting a liquidity discount when you invest in the public markets. And what I would suggest is that you look for an illiquidity premium, and you're duration matching this long-term cash, which is your retirement money, with a long-term investment opportunity.
What Eric's saying is the PayPal thing, right? With Peter Thiel is like my Stocktwits stock, my Robinhood stock. If you believe in it, that's the beauty of Alto IRA. You put this in your custodian. The other thing that Eric's not talking about is, even though I'm old, I fought with Pacific Premier and all the people that like are being destroyed. It's not just the fact that you can invest in private markets. The fight we're making for Shay and you, Katie, is that just like Schwab and then Robinhood disrupted pricing, there's a huge pricing issue in this custodial market. So if I have private crypto at Pacific Premier, one of the old custodians, they're in like no one's watching their back. So if you have Bitcoin or some obscure private investment go up, guess what they're going to bill you, even though they're not doing any work, the custodians, the next year. So one thing that's super important about all this, if you're going to deposit your hard-earned, researched private investment, that you made, whether it's Facebook or whether it's Bitcoin or whether it's Stocktwits or Robinhood at the time, and then get a sticker shock the next year from the custodial company of old because they decide to charge you based on the assets under management. They did nothing for that business. So there was also that problem that Alto has, taken the risk and built another custodian, so that not only can I get access to these, but I can get access to them and house them legally as a custodian and not get pillaged year 3 when the thing works out, because they now start taking my profits from me just for the privilege of holding these custodially. So there's a lot of disruption that had to go on there as these rules changed. Because like this duration issue that Eric says, I want to hold my private stock there for 10 years. The custodial is really doing nothing except, digitally holding some certificate. So what are they entitled to for that right over the years? So we also had to have the Schwab and Robinhoodification of these custodial service. So that's what Alto IRA is as well. So this is like a double win for the consumer. It's a modern design. It's a modern way to pay for all this, obviously a much lower price, and then also a modern way to access all this stuff. So it's really, kind of a 3-banger there. And Eric, how'd I do on that one?
I'm glad you did it. Now I don't have to do it. Yeah. No,
It's
okay.
teamwork
I'm saying
makes
I'm
the
a
dream work.
customer, right? Like I know you guys, we all think about Facebook and we all think about Robinhood, but until this stuff is not just put into law, but then entrepreneurs go and like take on the incumbents in this custodial space, which Eric and team have done, and that's why I invested. All these rules will just lead you to small investors getting ripped off 1 or 2 years later. So at least now that we have the rules, we also have the technology and now the companies and the investors putting up money into these things so that the actual new investors that get onboarded because of these rules don't get ripped off.
Yeah, and Katie, Howard's referring to our pricing. So when I made, by the way, I got into this because I was also a self-directed IRA customer investor, and they were charging me based on the investments I was making and the performance of those investments, which they had nothing to do with.
Right.
And that didn't make sense to me. And so at Alto, your account fee is a fixed number, no matter how much you put in the account, no matter how many investments you make in the account. And I just think that's the right way to do it.
Yep.
One of the things I'd love to talk about is portfolio diversification, because we were sort of touching on it earlier. But Larry Fink, who is at BlackRock, famously wrote in his letter at the beginning of the year that 60-40 is dead. He's of course referring to 60% equity and 40% bonds, and that we're now in the era of 50-30-20, which I'm fully supportive of, except for the fact that I'd like to reframe it, because I don't think it's going to be 50-30-20 ultimately. I think it's going to be 20-30-50. And the way I think about it is the 60 gets split 30-30, where you're in private equity and public equity. And the 40 gets split 20-20, where you're in public credit and private credit, or public income and private income. And so, I'm not the best at math, but when I add that up, I get 20-30-50, where you have 20 in public equities, 30 in you have 20 in public credit, 30 in private equity, and you get 50 in all privates. And that's the direction I think we should go in order to get true portfolio diversification. And as a result, you get reduced volatility, and you can have the opportunity for outsized returns.
Yep. And with that, I know we have just a few minutes, but I think it brings up something that might be interesting to touch on before we leave, which is just how you're evaluating opportunities as an investor. I think a lot of people came into the market, even, our generation, through Robinhood or maybe through crypto and then stocks, and like analyzing companies or crypto assets so different than a private investment opportunity. It's less liquid, there's less information. How should people think about, or how do you guys help people understand, okay, I'm evaluating Apple versus this thing over here that, different time horizon, different structure. How should people think about that learning curve?
Yeah, and I don't think it's Apple versus early stage private company. I think it's early stage private company versus early stage private company, or middle market versus middle market, or growth versus growth, right?
Yep.
it's not that I'm not a fan of public markets. I believe public markets have a place in portfolio construction. I also believe that private assets have a place in portfolio construction. And so if you go to the altoira.com website, there are FAQs and there is, essentially, let's just call it a help section where you can begin to get smarter in terms of how I should evaluate a particular investment opportunity or a particular company or a particular industry. But to Shai's point, by the way, I think what's happening more and more is people are going to go to AI and say, hey, I'm interested in company X. They participate in industry Y, and I'm not sure who their competitors are or how they're performing versus the market. What do you think? And that's going to be the first level of diligence that people are going to do. Mm-hmm. And so I think technology is now going to be a huge sort of accelerant to the average individual's ability to participate in the private markets.
Yep. Fascinating stuff. Definitely go check out altoira.com. Did I get that right, Eric? altoira.com. And I guess real quick, we have a couple minutes. We have big earnings. Let's do a lightning round of the two big earnings coming later today. We got Apple, we got Amazon. Of course, the other big headline is that Katy Perry, the other one, is apparently dating Justin Trudeau, which is blowing up my mentions. But yes, Howard. Yeah, how do you feel about that? That's a nice little alliance we're forming.
Listen, at my age, I don't feel much, and so this didn't change anything. I'm just a little bit threw up in my esophagus.
Yeah, so let's table that though. Okay, Shay, Apple, Amazon. Real quick takes on those. What are you looking to see? And then I'll get to you, Eric, and you, Howard, for final thoughts.
Yeah, so Amazon, pressure's on. I think you're seeing cloud just be on absolute fire. If AWS does not deliver in a similar fashion on exceeding expectations as Azure and Google Cloud did, they're losing market share. And they're not just the clear tier one player anymore. Like Azure is really catching up to them on dollar to dollar comparison. So law of large numbers isn't really a good argument anymore, because in 2 years they might be in the same revenue stream because of Azure growing 2x the year-over-year growth the AWS is. So I think AWS has to deliver. I want to see the retail margins stabilize. I kind of this is my biggest position. I'm upset that I chose this over Nvidia because of I thought it was the best highest floor, highest ceiling combination between the two. I was clearly wrong, but AWS needs to deliver. So Apple just needs to show a pulse. If they show a pulse, they're going to catch a bid. They're lagging. They have a massive moat in 2.4 billion devices. If they show any kind of AI pulse, I think it'll do just fine. It's all about the China market. See how much the China market is getting hits. But expectations are really low. I mean, look at this. Like they haven't moved. They've lagged. Market's at an all-time high with Apple just clearly being the major lagger. But their PE ratio is 32. Their PEG ratio is the most expensive among the Max 7 at 3.2. They're not.
We keep dogging on Apple, and it's like I was like starting to feel bad for them, but I'm like, it's Apple.
No, and they're also losing their talent too. Like COO left, their top AI researchers left. Like they're in a really bad spot right now. So I just think they need to show a pulse, and maybe they'll catch a bid.
All right, got some good stuff coming. Howard, any quick final thoughts from you as we round out this episode?
No, I mean, I'm really happy to see all the improvements at Stocktwits. We're working really hard to make it easy for people to see more data, but also contribute. Listen, Apple, I'm just loyal. I'm still in a long-term uptrend. But again, much like they have a China problem, right? Because tech, he's kissed the ring, not quite as strongly and wetly as NVIDIA's Jensen Huang. And it's just such a big company, right? And much like we're seeing with fallen angels like Lulu and Deckers, it's when you have a complicated business with a president like Trump who's changing numbers around tariffs as if it's just kind of a carnival, and then at the same time you have interest rates at 8%, It's just a difficult environment to run a company like Apple compared to a company like Meta. But it's hard for me to have an opinion because there's too many moving parts. But I'm staying long. The way to own Mag 7 is still QQQ. I think I get cute with it by owning 2 of them combined with a bunch of other smaller companies in my degenerate economy index. But really, the way to own this has been the QQQ. So I'm sticking with it, and I hope both of them, have a great quarter.
All right.
Eric?
We'll see. Eric, you can close us out for today as our special guest. What's top of mind as you had a note Friday and the weekend?
So first of all, Katie, Shay, Howard, thank you for having me on.
Thank you for joining us.
I told you earlier I was in New York yesterday, 100 degrees walking the streets. That was brutal.
Horrific.
So I'm looking forward to a more relaxing weekend with some finer weather.
Good. Enjoy the Gloucester.
Gloucester.
The Gloucester.
Katie, I'm just gonna send you a shirt.
New Hampshire.
It'll be like GLOSTA, but it's GLOUCESTER.
Fun. I'll wear it. People need to be educated on this and also private market investing opportunities, which you can get educated on at altoira.com. Everybody, thank you so much for tuning in with us this week. We will be back on Monday. Tomorrow, don't forget to turn into the weekend whip with Ben and Emil, and I might make a surprise appearance on that, so that'll be fun. Thank you, Howard. Thank you, Shay. Thank you, Eric, and we'll see everyone next week.